Happy Monday, everybody, and welcome to the first Monday market update of 2024. Last week we had the first update on Tuesday, so today is January 8th, 2024, and this is your Monday market update. A few reminders, please watch for some changes in the distribution of these videos. I hope to make it easier for you to get, watch, and share, and only get what you want. Watch for more details. As we are now past the first week of market action 2024, let's review that first week and let's preview week 2 and beyond. Markets closed the year with a whimper on the 29th and came out, as I've been suggesting, in the red in the new year. Again, closed on Monday for the New Year's holiday, so those who don't like Mondays, you lucked out again. This week we have one, but again, later in the month, we'll get another Monday off for MLK Day. Before the open on Tuesday, futures were looking down, not catastrophic, just red, which was a new color for recent weeks. As one of the researchers I work with said, don't read too much into this. A few items of news, but nothing earth-shattering. Treasury yields are up a bit, and that has been enough to have the algos sell. Add in a better than expected PMI overseas and light US PMI, and probably the loudest voice in the room, China's president comments about caution in the second largest economy in the world, but even that was muted. The moves we saw were really just New Year's positioning, especially as I told you, many people waited until 2024 to take profits, giving them 16 months before those tax bills are due instead of 4. So we did get some company and industry news. Apple was downgraded by Barclays to underweight, not sell, and the price target was dropped by $1, 161 to 160, and the stock fell by 3.5%. Note, the stock is over $20 above that target price, and underweight is not a sell, and Barclays and this analysts are not LPL or Goldman. So why did it go down? Again, just looking for a reason to sell. It's positioning. Chips got hit on news of another company getting told that they cannot sell to China. Oil started up and reversed. The other commodities did the same. The dollar was up a bit, had an ugly 2023. Positioning. So you get my point here. Not a pretty day, but not much to see here. The Dow was up by the end of the day, less than 0.1%. The S&P was down about 0.5%, and the NASDAQ was down 1 2/3%. Worst day at the NASDAQ in a while. Note that the year started with some calls to trim your winners. I will add a few things on this. First, we've talked about that a lot. This is a risk thing, nothing more. When the stocks rise too much and become a larger part of your portfolio, too large, thus making the risk rise above your goals and your comfort, that may be time to trim. As for the calls on TV, I question why all of a sudden 2024 brings this call. Why trim now? The prices should look no different now than they did last week. There are times to trim winners and take gains, but all of a sudden these calls say that they've gone up enough? Really? They could have said that same thing 10% ago on some of these, 20% ago, or 30 or 40% ago. So let's not get sucked in here. There are good reasons to trim positions, but we should talk about that. The trim that they are touting is about trading, regardless of what they say, and that is not our plan. Long-term goals. Okay, now back to the recap. Wednesday had bond yields moving up and stocks come up for sale. Fed had Barkin from Richmond, was all over the place, but enough tape bombs to get things going. He said that hikes were not off the table. Hello? Saying that to a market that's priced in 6 rate cuts in 2024 is like yelling fire in a crowded movie house. All that, and he also said that a soft landing still looks possible. So can you have both, or really all 3? Hikes, soft landing, and 6 cuts? No one actually held him accountable for this disjointed comments, but by the 10 a.m. hour Eastern, JOLTS and December ISM manufacturing reports are out, and stocks bounced a bit. Neither report was meaningful enough to change Fed expectations, so the spotlight went back to the hikes are still on the table idea, and stocks rolled over and stabilized until the Fed minutes that came out at 2 p.m. Eastern. As I told you last week, this was the time to see what was really said, and the words higher for longer, along with unusually elevated uncertainty, was enough to have stocks roll over yet again and into the close and finish near the bottom of the range. Markets were really just getting set for jobs data Thursday and Friday. By the end of the day, the Dow was down 0.75%, S&P was down a bit over that, and the NASDAQ was down over 1% for the day. Oh, by the way, markets made Santa's naughty list, the Santa Claus rally, as defined by the last 5 trading days of last year and the first 2 of this year. S&P was down 1.1%. And since we are in the habit of using history as a benchmark, when this happens, the S&P forward annual return is only 4.1%. And this is the 16th time that's happened since 1950, and it breaks a 7-year record of positive. January ends in the red 60% of the time this happens. And although I wanted to share that with you, please remember this is history, and it is also only one input into the historical performance. Since we are into fun facts, I will add that the Magnificent 7 stocks from 2023, the market value of these 7 stocks is roughly equal to the combined value of the UK, Japan, and Canada stock markets. All right, Friday Eve, also known as Thursday, we had stocks looking higher at the open for a while until we got a hot jobs report. This one, the ADP report, as markets got moving, eco data from Europe was hot, and that continued to chip away, and the high for the day was hit when the European markets closed. A second Apple downgrade helped to move tech stocks back into the driver's seat, and of course on the downslope, markets once again finished near the lows of the day. By the end of the day, the Dow was flat, S&P was down 1/3 of 1%, and the NASDAQ was down 1/2 of 1%. For those watching at home, inflation still showing Goldilocks in some of the reports. Let's keep an eye on it. But oil has spiked as the attacks in the Red Sea continue. Traffic in the Suez is down nearly 30% in the past few weeks, and that helps to push container shipping rates up about 55% from the Asia to U.S. East Coast and 3 times for the Asia to Northern Europe route. And that also in the same breath as the delay that's also in the same breath as the delay in the shipments. Can we recall supply chain problems? And as we spoke about a few weeks ago, Major League Sports are dealing with inflation. Just ask the Dodgers. But the NCAA is getting their fair share too, signing a new media rights deal with ESPN, nearly triple from the current deal they're on right now. Jobs Friday did not disappoint. More jobs and stronger wage gain than expected, sort of better than expected. And we all know what that means. Good? No, bad news. Good news is back to bad news. If things are so good, can the Fed really start cutting rates like the market is pricing in? This print made major changes to those future markets. As of Friday morning, per Bank of America, the biggest inflow of investment dollars year to date, cash. Let's see what happens from there. All of that, and by the end of the day, markets did snap a 9-week winning streak, closing down for the week. But for the day, Friday, the Dow and the NASDAQ were both up less than 1/10 of 1%, and the S&P was up just under 1/4 of 1%. For the week, lower as I mentioned, the Dow was down 1/2 of 1%, the S&P down 1.5%, and the NASDAQ down 3.25%. Yes, last year's heroes are this year's zeros after 1 week. So the end of the week, the end of week 1, what does week 2 for the first full week of the year hold in store for us? There's a lot. You will recall that we are usually quiet in the week after jobs week. Not so this week. We have earnings starting on Friday, big banks, and this will be a very important earnings season as we've discussed. We will get CPI on Thursday, PPI on Friday, and those are huge. Other smaller eco data, add in consumer credit info, and of course the weekly jobs info on Thursday. A lesser watched small business survey of optimism. Remember, this country virtually rolls along on small business. And not to be left out, the Fed heads are back on parade. Bostic Barr's William and Kashkari before the week is out. This is going to be a big week. As we move into week 2, I do want to point out a few things. A long journey to nowhere has happened. 2023 saw the 10-year Treasury go from a 3.88% yield in January to a 3.88% yield in December. And the S&P had a great year, up 24% on the year, hit an all-time high of 47.96 in January 22, and closed 2023 up 24% for the year at 47.90.25, below the January 2022 close. This is just another example why you have to be careful watching and listening to just the news. Just because these facts are true, 12 to 24 months of little movement doesn't mean that investment returns also had no movement. As we go into the new year, please keep in mind that we are chasing your goals, not an index number. And that chase is one that can be addressed in many ways. It depends on what the goal is, when the goal should be met, and even what kind of risk you can live with. So please keep in touch. The new year may bring a lot of new ideas and new opportunities, but none of them are for everyone. Everyone has their own. Please check back in on Friday for the planning video and come back on Monday for the market update next week. Have a great week.